Hello, this is a synopsis for Chapter 2 for Finance 356, and I just wanted to highlight a few things in this chapter. In particular, I wanted to discuss how to short sell a stock, because that can be a little bit of a confusing concept for some people. So let me open up the slides and we'll proceed. Okay, so Chapter 2 just talks in general about the securities markets rather. Let me move this out of the way here. All right, so when you purchase a stock, you have the bid and the ask. So if you go into, let's say you have an account at Robinhood, or you have an account with Charles Schwab, Fidelity, E-Trade, Ameritrade, whatever brokerage account you have, when you pull up that account and you go to purchase a stock, there's going to be two prices. The ask is what you would get as a seller. If you're buying the stock, the ask is what you would get as the buyer. If you're a seller, you would get the bid. And so there's usually about a penny difference. Most stocks are frequently traded, and the market maker is the person who basically facilitates all this, and they would basically get that penny difference. But generally there's about a difference between about a penny, as I mentioned, between the bid and the ask. So also that prevents arbitrage, because if I could buy something less than I could sell it, in other words, if the ask were a penny less than the bid, I could buy and sell all day and use a computer and make a bunch of money just by earning that penny. So you have so it prevents arbitrage when you have this difference between the ask and the bid. So as I said, most stocks are frequently traded. They're very liquid. So you have about a penny difference. But if you have stocks that are very thinly traded, maybe a small company, then you could have a larger spread. It could be maybe 2, 3, 4, 5 cents, maybe 20 cents. Also, most people buy and sell stock during regular trading hours. And for Central Time, the market opens at 8:30. The American market opens at 8:30 Central, closes at 3 p.m. Central. But you can also purchase stock. You can make trades between 7 and 8:25 in the morning, pre-market, or you can also make trades post-market. And so usually when you have that situation, it's more thinly traded, and you see this big difference between the bid and the ask. Okay, so the spread is the difference between the bid and the ask. Market makers facilitate the transactions. All right, so you basically have two types of markets. You have organized markets that are physical exchanges, like the New York Stock Exchange. You can actually go and visit the New York Stock Exchange. It's considered a physical market. Then you have what's called an over-the-counter market. The NASDAQ is really just a consortium of different buildings around the country, if you will, that have computers. So the NASDAQ is considered an over-the-counter market. It's not a physical exchange. The New York Stock Exchange, as I said, is a physical exchange. So those are the difference between those two types of exchanges. In finance, of course, you have these financial analysts who construct these earnings estimates. So companies report their quarterly earnings, which is really important, because whether they meet or don't meet the earnings expectations of the analysts, it can really make the stock move one way or the other. So one thing that financial analysts do is they try to figure out what the earnings reports are going to say. And so, like I mentioned, when these companies report earnings, usually they tend to beat the analyst estimates. If they don't beat the analyst estimates and it's a downside surprise, the stock will usually move down. If they do beat the estimates and it's an upside surprise, then the stock will generally go up. Also, sometimes companies, though, can beat the earnings estimate, but their forward guidance might, when you get down in the details of the earnings report, the guidance might not be very positive, and that can cause the stock to go down. But anyway, there's a whole industry of these analysts who try to value the stock and figure out what the earnings estimates are going to be. And in financial analysis, you have two types of analysts: buy-side analysts and sell-side analysts. So if you ever read about this or hear this, now you'll know what it means. If you're a buy-side person, you're basically recommending purchases for your clients, like mutual funds. So there's institutional investors, mutual funds, and you're giving them recommendations. So you're a buy side. If you're a sell side, you are providing recommendations to use by brokers to sell to their clients. So that's the difference between the buy side and the sell side. Okay, the role of brokers. Now, the industry has changed quite a bit over the years. You probably have all heard of Robinhood. Robinhood's only been around for maybe 3 years or so. So Robinhood got started. So for those of you who aren't familiar with Robinhood, Robinhood is an app where you can download this app on your phone and you can buy and sell stock free of commission. They don't have a full array of stocks, but pretty much every stock you'd want to buy, you can get on Robinhood. Some penny stocks or some thinly traded stocks you can't find, but pretty much all the mainstream companies you can buy on Robinhood. So Robinhood really turned the industry on its head because Robinhood started this their brokerage firm. It's super user-friendly, really geared toward millennials, and they don't charge a commission. Whereas these other brokers like Schwab and Fidelity, E-Trade, Ameritrade, Scottrade, they charge a commission. The commissions have been going down over the years, but the lowest they went was like $6.95 a trade. So if you bought a stock, you had to pay $6.95. If you sold a stock, you had to pay $6.95. Some of the really discounted brokers were charging like $3.95 a trade. Well, after Robinhood came out, in order to compete, all these brokerage houses suspended their commissions. So now you have to ask yourself, do I really need to be on Robinhood? If you have a Robinhood account and you are planning on, if you're investing now and you're going to be a serious investor, of course, if you're investing now, you're probably going to invest through your whole life. You might want to just open up an account at one of the mainstream brokerage houses, because Schwab, for example, or Fidelity, as I said, Ameritrade, E-Trade, any of these, they offer better services, in my opinion, than Robinhood. You can, especially Schwab, if you call Schwab, you can talk to them on the phone, and they're reputable, and they don't charge a commission anymore. So you might want to consider that. And they have apps too. It's not quite as user friendly, but you can go in to download the Schwab app or the Fidelity app. I think Schwab is more user friendly, and the services are just as good, if not better, than Robinhood. It's fun. It's cool to have a Robinhood account, but they had some issues a few months ago during this whole GameStop fiasco. When GameStop went way up, they had some liquidity issues. And so it caused a lot of people to close their Robinhood accounts and transfer them over to a more full service, a more reputable broker, not full service, but a more reputable broker. So anyway, I have a Robinhood account. I was thinking about transferring it over, but I just didn't bother. I don't think you're going to lose your money in a Robinhood account, but there's nothing right. There's really not an advantage to have a Robinhood account now that these brokerage houses are not charging a commission anymore. So anyway, what are we talking about with the role of brokers? Well, these discount brokerage firms, that's the firms that I've been talking about, like Schwab or Fidelity. You don't get any advice from them but their fees, they don't even charge fees anymore, really. They don't charge commissions anymore. So that's where most people go. A full service brokerage firm would be a company like Merrill Lynch. That's a company that's going to give you advice. They're going to charge you, and they're going to manage your accounts and give you advice on what stocks to purchase and so forth. Okay, electronic trading, that's self-explanatory. All right, so those are the main things I wanted to talk about on that page. Okay, this seems obvious. I'm sure you all know what this means, but it is good just to go over it because some people, you may not know. If someone has a bullish position, that means they're bullish on the market. They have a long position. They're buying low and selling high. If you're bullish, you're anticipating the stocks to go up, the market to go up, so you're buying. If you have a short position, if you have a bearish position, that's a short position, you're anticipating prices falling. Okay, so this is where we get into short selling. Well, we're going to talk about short selling in a minute. Bullish is long position, bearish is a short position. So we'll come back to the short position. First of all, though, let's talk about how the types of orders if you're going to purchase a stock. So you can have, there's different types of orders. If you go into your account and you purchase, let's say you're purchasing a stock, you can put in a market order or a limit order. A market order means that you're going to accept the price of whatever the price is. So let's say that you want to buy some apple, and apple's trading for a dollar, $135.01. That's the ask. And the bid is $135 even. So if you put in a market order for $135.01 and you press the button, you're probably going to get that right away. It's not going to change. But if it happened to change in between the time you press the button and the order is filled, you're going to get whatever the market order is. It could be 135.02, could be 134.99. So a market order just means that you're accepting whatever the price is at the time that your order goes through. So with stocks that are frequently traded, like most stocks that we purchase, it's not a big deal to put in a market order. Especially if you're buying and holding, who cares if it's a few pennies, right? But if you have something that's very thinly traded and might have a spread of say 10 or 20 cents, then maybe you'd want to put in a limit order. Also, if you think that, let's say that you think that throughout the day, the price might go down, you can put in a limit order. And if the price goes down, you'll get a better price. So with a limit order, you name your price. So let's say that Apple, let's go back to Apple, it's trading at $135 a share. And you think, well, it may go down, it's the morning, the stock market may take a little turn. So I'm going to put in a limit order of $128. Or maybe you've looked at the charts and the charts are saying that Apple may go down a little bit. So let's say I put in a limit order for $125. Well, I can put in a limit order that's good for the day, or I can put in a limit order that is good until I cancel it. And so if it's good for the day, then if Apple doesn't go down to 125, my order's not going to be filled. But if it's good till canceled, that order just stays open. And if Apple goes down to 125, my order is going to execute. So some people really swear by these limit orders because you can get a better price and save some money in the long run. Here's the problem with them, which is frustrating. Let's say that you're waiting to buy Apple, you put in a limit order, and the price just continues to go up. Well, then you've lost out. So like I mentioned, it's the only time I would put in a limit order is if the market's real volatile and I think the stock, if it's a real volatile stock and I think it might swing down, then I'll put in a limit order. But otherwise, I usually just do a market order. Okay, a stop order typically is called a stop loss order. So that is where let's talk about a stop loss order because that's the most common one. That's where you put in an order to sell something at a certain price that you own. So let's say that you bought, let's say you have a whole portfolio full of stocks, and you don't want to sit by your computer and look at the prices all day because you have a life, you have classes to go to, you have a job, but you don't want to get caught in a downturn either. So you put in these stop loss orders. So let's go with Apple. Let's say you bought Apple for 135, or let's say you bought Apple for $135 and it's up to $150. And you say to yourself, well, I'd really like to preserve my profits. If the market has a downturn, or there's, something happens on any given day and the market has a downturn, I don't want to lose all my profits. So let's say that you decide that you're going to put in a stop loss order at $140. Well, if Apple goes down to $140, your stock is going to automatically sell. So so people will put in these stop loss orders to limit their losses. And the stock will automatically sell if the stock goes down. Here's the problem with that, is if you have a volatile market, for example, let's take Apple. Let's say Apple trends down to $140, your stop loss order is executed, and then it goes right back up. So you've gotten stopped out of your position, and now the price is back up again. So that's the downside. If you have market volatility where you have a dip and goes back up again, then you get stopped out of everything, and then the price is up again. So as I said, it's like anything in life, there's risk, there's cost benefits to everything, but that's what a stop loss order is. Okay, we're going to skip this. These are the settlement charges, or the settlement issues. If you sell a stock, it basically takes 3 days to settle. So if you sell something, let's say you wanted to sell something and transfer the money out of your account, unless you had some margin in there or other holdings in there, it would take 3 days before it's actually settled, and you could transfer the money. I can tell you from experience in Robinhood, it usually takes 5 days, which is really aggravating. If you sell something and then you want to transfer that cash back to your checking account, it takes 5 days, which so you just have to keep that in mind if you have a Robinhood account. But anyway, most of these traditional brokerage houses have a 3-day settlement. Okay, margin. Now, margin is basically borrowing money from the brokerage house. So for example, I'll use Schwab because I'm familiar with Schwab. If you put $5,000, if you have a minimum of $5,000 in a Schwab account, they will let you buy up to $10,000 in stock. So they're going to give you 50% margin. So margin is the amount, basically the amount that you're putting up. You would think margin would be the amount that you're borrowing, but the margin percentage is the amount that you've put up. All right, so what they'll do is the initial margin is 50%. And so, like I said, if you have $5,000 in a Schwab account, they'll give you $5,000 in margin. And they will let you buy up to $10,000 worth of stock. I don't really recommend using margin. They charge you margin interest. They're going to charge you interest just around 6 to 7% these days. And here's the problem. If the market trends down, you can get a margin call. So the Securities and Exchange Commission has a certain level. I think it's right around 30%, a minimum margin requirement. So if you trend down to where you only have 30% skin in the game, right around there, you're going to get a margin call. And the margin call means you either have to put more money in, or you have to sell the position. And when would you be selling the position? At the most inopportune time, when it's gone down. So that's what margin is. And also think about this. If you have $5,000 in, and the brokerage house has given you $5,000, you've invested $10,000. If the account goes down 50%, you've lost 100%. So think about that. You've invested 10,000, but you only put up 5,000. So if the account goes down 50%, all that $5,000 that's gone, that's all your money. The brokerage house isn't going to lose any money. It's all going to be your money that's lost. So if you go down 50%, you've lost everything. Of course, you can make twice as much money on margin, so to speak, but you can also lose twice as much. So if you have an account that's on margin and your account's up, let's say you have $10,000 and you go up and your account increases by $1,000. Overall, that's a 10% return, right? But it's really a 20% return because it's $1,000 divided by the $5,000 that you put up. So you're making 20%. But if your account goes down $1,000, you're down 20%. So you see, you can make twice as much, but you can lose twice as much. So as I mentioned, resist the temptation to go on margin because it's very risky. Okay, so we talked about commissions. The last thing I want to talk about in this chapter is short selling. So what if you think, okay, you can the way most people make money is by, you make money in the stock market through dividends, of course, if the stock pays a dividend. You also make money through capital gains. You buy low and you sell high. So you buy a stock at one price, you sell it at a higher price, you've made money. It's buy and hold. Well, you can also make money on the stock if you think a stock is going down. It's called selling short. So it's kind of confusing because you're selling first and then you're buying. So what you would do is, let's say you think Apple's going to go down. Apple's at about 130 right now. Some people think it's going to go down to like $100. So let's just say you think Apple's going down to $100. So you go into your account and you click on the box that says short sell. It's going to show, let's say that you short sell one share of Apple, $135. Your account is going to say -1 share of Apple, $135. What that means is that theoretically you've borrowed that share from somebody and you have -1 share of Apple. So you've sold it, okay? You've sold something you don't really own, it's borrowed. So it's going to say -1 share, $130. I think I said 100, whatever price I said before. Let's say 130. So -1 share, $130. Now you wait for the price to go down. Let's say the price goes down to $100. So then you say, okay, I'm going to get off my short now. The price has declined. So I have made $30 there. Went from 130, if it goes from 130 to 100, I've made $30. How did I make $30? Well, I get off my short now. The way I get off my short is I go in and I buy the stock. So I go back into my account and I click on buy 1 share of Apple, and it's going to negate the short sell. So now it's going to say 0 because I had -1 share, right? I bought it. Now I have bought 1 share. Now it says 0 and I have a profit of $30. So that's how you short sell. If you think the stock is going down, you short sell it, you're selling high, and then you're short selling it high, and then you, as the price goes down, then you buy it, and the difference is your profit. Short selling is very risky. I don't recommend that either, because even if you think that the market's going to go down or the price of a stock is going to go down, it's all in the timing. So, some things have been a no-brainer, like Radio Shack, J.C. Penney, some of these companies, you knew they were going to go down. BlackBerry is another one. But the problem is, over time, they can get a new CEO, they can get a new manager, they can have a good earnings report, and they can go up. So things don't always go straight down. And so if you're short selling and the price doesn't go down, if it goes up, then you've got a huge problem. Because think about this, What's the maximum amount that you can make on a short sale? The maximum amount you can make percentage-wise is 100% if the stock goes down to zero, right? What's the maximum you can lose? The maximum you can lose is infinite, because if a stock goes up, if it goes up by 100% from, let's say you bought Apple for 130, if it goes up to $260, you've lost all of it. You've lost 100%. If you're still on that short, your brokerage firm is going to call you and have you put up more money. They're going to actually call you before it gets to 100%, but you're going to have to put up more money. So you can see that your losses can be infinite because the price can go up infinitely. So it's really risky to short sell. I do not recommend that. But anyway, hopefully I was clear on what a short sell is and explain that to you. All right, so don't worry, these are really confusing. To me, they make no sense, so just skip those. That's basically what I mean, you can read the rest of the chapter, but that's what I wanted to really focus on in the synopsis, is the margin, buying on margin, and how to buy and sell stocks and short selling. All right, so that is this is a synopsis of the main points in chapter 2. And take care and goodbye for now.